All right, good afternoon, everybody. Check, check, radio check. It is 4:30 Apple time, and I want to go ahead and get started. And we have some people on, LinkedIn and live streaming, and we'll get some latecomers. But I like to get started on time. We do have a hard stop at 5 o'clock, so I'm going to try and go quickly, but I wanted to talk about the Fed because we often hear terminology and we hear language either on the news, on the radio, on TV, and they're talking the Fed, the Fed, the Fed, the Fed. And what does that mean? Who is it and why? So, who is the Fed? The Federal Reserve, the Fed, is the central bank of the U.S. It was created in 1913. And I was just doing a Social Security workshop, and I point this out when I show the history of the income tax. That's the same year that Congress enacted the income tax as well. But it's composed of the Board of Governors, 12 regional banks, and the Federal Open Monetary Committee, the FOMC, which really they're just setting policy. And these mandates are to maximize employment, right? So they want to make sure we can get as many of our fellow Americans working, sort of combat inflation and, create stable pricing and then moderate long-term rate, for long-term purchases. But the Fed does influence borrowing costs, spending and credit. It lowers rates, stimulates the economy. Higher rates slow it, right? So think about it. If right now we came off, you're going to see some charts. We came off a period through COVID where rates were suppressed. And now, that inflation was a concern, they had risen and increased the borrowing rates. Well, if you're a first-time home buyer and you were looking last year, interest rates almost got to 80% or 8% for a 30-year fixed mortgage. So, that's why the bottom bullet point, rate changes affect our mortgages. It affects us borrowing money, loans, credit cards, how we finance things, our savings, right? As financial advisors at Professional Planning Services, one of the things that we do specialize in is, safe money or places to put money. Typically we'll use MIGAs, multi-year guaranteed annuities, and those are guaranteed by the insurance companies, and they are a true indicator of what short-term rates are like. And then fixed income returns. So that's what the Fed does and who they are. But this is a sort of a scattergram or plot map showing how we were low in January 22, quarter point, and then systematic 11 increases over the last 2 years. And so the big picture between March of 2022 and 2023, the Fed lifted interest rates from near zero to 5.5%. It was the fastest tightening in 40 years. So the aggressive action was aimed at reining in inflation. So definitely the markets are spooked, people are spooked, things are, multitude of reasons. Everybody's pointing the finger at everybody else, but at the end of the day, when you're going to the grocery store, to the gas station, or you're buying something and you're saying, "Hey, just last year it was less expensive," that is inflation and what they're trying to curb. So the key takeaway is the Fed's rapid hiking campaign reshaped the financial landscape. And although it's painful, I'm not buying a house. I was just on a phone or on a call with a client yesterday, a young couple, and they're looking to buy a house, but affordability is a key conversation that they're having, and they're like, well, interest rates, but when back through the Jimmy Carter years, and if you remember back into the late 70s, early 80s, and interest rates, inflation was 14, 16% for a 30-year mortgage, right? That tells you, hey, Houston, we have a problem. Yes, 6% right now. I think a 30-year fix is between like 6.1 and 6.5, right? So if that's the case, it's reasonable. It's not out of the ballpark. It's not eight and it's not four. but it's reasonable. So I think things are starting to get reset. That's my personal opinion. But the rate cycle, so in 2020, 2021, COVID pulls the rates down from 0 to 1/4 point, right? And we strongly committed to using the economy. And then, they said, oh, it was transitory. And then the language shift. It's, well, it's probably a good time to retire and try to explain more clearly what we mean. And then by 2022 and 2023, I'm over here on the steep climb. 11 rate hikes. CPI, Consumer Price Index, peaks at 9.1 June 22. That's what spooked them. Right there, when they see inflationary numbers approaching double digits, they felt they needed to take action. So we are taking forceful and rapid steps to moderate demand and keep inflation expectations anchored. And then 2023 to 2024, the Fed has held rates for at 5.5 for 14 months. And September of 2025 is the first rate cut in like a year, right? So they are trying. So when the Fed is part of this is what the Fed's charging, at the window and banks and borrowing. But when we go, it's a little bit higher. And when I say a little bit, that's why I said it was 8%, and maybe it started to come down to 7.5. That amount of extra borrowing costs is how the financial institutions make their money. And then September 2024 cuts begin. And with inflation easing, Fed started to lower rates in three consecutive meetings to 4.5. So unemployment now is the Fed's biggest enemy, not inflation. So they want to make sure that enough people are getting back to work. There's some charts here. We're going to look just, as I reference a purple, an orange, or a blue, what I'll try and do is target. So the purple is the target Fed funds from 23 to 24. So it was running flat and they're trying to drop it down. Then we have the US unemployment rate. And so we've seen this starting to creep up and then it tailed off. So they are watching this because that dotted orange line is where they're concerned with. And then the US initiates claims for unemployment, right? So again, if you have a bunch of people running out collecting unemployment benefits, that is a concern and something they're watching. So the big picture from July 23rd to September 24th, rates are held at their highest level since 2001. While inflation began to retreat following three cuts at the end of 24, the Fed has kept rates unchanged despite rising expectation for further action. So the key takeaway, these holding periods reflect the Fed's preference for caution and confirmation. By keeping rates high, policymakers sought to ensure inflation progress was durable before easing more broadly. For consumers, that has meant an extended stretch of elevated borrowing costs and historically high cash yields. So that's the other side of it, right? So there's the pros, and I think that's on the next slide. But this guy here, Jerome Powell, prior to him, it was Janet Yellen. But these guys are appointed, and again, they don't typically, depending on which side of the aisle you're on, and I'm not getting into politics, but it always just seems like every administration doesn't like the previous administration's policies. So there's been with the current administration some back and forth and name calling and finger pointing, but basically what he said is with policy in restrictive territory, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. The other side of that coin is it's probably taken too long to get there, but I could sit here and play Monday day quarterback all day, and I don't think it's productive. So as I come back and I say, look, calls for cuts in 2025, that's the purple. Then we have U.S. Consumer Price Index year over year, and then we have U.S. unemployment rate, and then we have U.S. continuing claims for unemployment. So the big picture, the Fed September 2025, remember that was the first time in a year to cut 25 basis points, comes against a backdrop of mounting pressures. That's, I'm going to say political and people sort of shaking them saying, "Hey, wake up, it's time." And then unemployment has climbed to 4.3 and continued claims at nearly 2 million after an extended period of elevated policy rates. So this is probably where they're getting a little concerned because we're approaching that dotted line. So it just this will constantly be topics that we hear about. But again, the purpose is what does it mean to us as everyday Americans? So the key takeaway: this cut resumes the easing cycle and signals a gradual move towards lower interest rate, which is good news. And both the bonds and the stock markets, people's investment portfolios will like it. When I say bonds, and we're going to get into that a little bit, let's see what the next slide. Oh, what happened there? What happened? Huh. Must have clicked on something. So I apologize. Trying to hit my clicker. So bond benefits as yields fall. Rate cuts typically push bond yields lower. The interest rate was cut, and if I'm a 70-year-old with $1 million and I'm in a bond portfolio and the bond yield at that time was 6%. I was expecting 60 grand of revenue coming off of my portfolio if I held all bonds. So the rate cut said, hey, we're not giving 6% anymore. We're maybe at, 5.5 might be the new rate. So basically, if I'm a person that needs 60 grand off my portfolio because I worked with my advisor and figured out that income gap and what we can reasonably expect to draw off the holdings, that could be a problem because money doesn't materialize out of thin air. Where did that shortfall? If I would needed 60 and I'm only getting 55,000 at 5.5%, where did that come from? And that's what rate cuts mean on the fixed side. But rates begin to adjust borrowing costs, especially on credit cards. This is where it's absolutely great for the economy, right? Nobody wants to pay too much in interest. Variable loans, I don't care what kind of product you're in. When you're in something that is variable, that's scary, right? It could be a variable mortgage, or maybe your credit card reserves the right to adjust pricing. So, fixed borrowing adjusts more slowly, but household debt pressure begins to tighten. I'm sorry, to lighten. So that's the thing is, if we're sitting here and we're struggling how to figure out our cash flow, and we know that we're paying off credit cards or whatever debt that we've entered into, lowering rates will make it easier for us in the future. How do stocks react to cuts? And stocks can be volatile at the start of cutting cycles, as many coincide with downturns. Over time, though, easing has supported strong market recoveries, with the S&P returning 9.3% annually since the Fed's 1981 peak. I also just feel that the bonds right now, we just last week have hit the U.S. markets, in the S&P 500, in the Nasdaq, in the Russell 2000. These broad indexes have all hit all-time highs. But as I listen to economists, and again, you're going to hear, for every person that says the market's going to go up, there's another person that says the market's going to go down. So what do you do? And that's where diversification strategies and things of that nature. But I do believe in betting on America. I do believe that as we are starting to clarify our role globally, I think that being in America, both the S&P, the Nasdaq, and the Russell will be long-term benefit for most Americans that invest there. However, work with your advisor and have strategies in place. And again, I'm passionate about this because technology is there that, who is watching all your retirement accounts on a daily and on an hourly basis, right? And if the last time you had a flash crash, right, did your advisor call you? Did your 401k plan advisor call you and say, hey, what do you want to do? And the answer is probably no. But now, again, this is why, working with somebody that has technology that can help you to monitor 24/7 your accounts and have pre-designed actions. Hey, if this happens, let's do this. We'll get together and we'll work out a strategy. This way, we're not emotional and we're not knee-jerk and reactionary. And then the last bullet here is cash yields begin to fade. So again, if you're custom, remember, I think back, and human nature is we tend to only be able to remember back about 24 months. But remember when banks, and you were putting all your money in your bank and your savings account, and hey, I would collect data from clients. Hey, what's the yield on your checking account, your savings account? They'd be like 0.25. I mean, it was next to nothing. So we called that going broke safely because here you are getting next to nothing on your cash. You didn't want to be in the market. You don't want to lose money. You worked hard, put all this money there. But now in the last, 2 years, we've seen, hey, we've gotten very comfortable. And that's why, part of the strategies I've worked with a lot of my clients is locking in some of these, 2 year, 3 year rates so that if they start to cut a little bit, we've maximized our return. So as cash yields begin to phase, as policy rates decline, high yield savings, CDs and money markets are going to lose their edge as well. Cash returns that surge during peak rates will step down over time. So just be aware that you will start to see lower rates. I know this is intuitive. I know you probably are already starting to figure that out, but it does sometimes help to hear it because you're like, I was sitting on 100 grand cash because I was getting 4% at the bank. But is that the best place nowadays? And I could probably show you better ways to lock that in, maximize return. So the bond market reaction, the big picture. And again, there's a lot of pretty colors here. We go over this once a month. We go over it. So bottom line is short-term treasuries, especially 1 month, 1 year, T-bills, keep lock and step with the federal fund rates, right? So short-term bonds will react quickly with adjustments where long-term bonds tend to take a little bit longer time to adjust. And then the cost of borrowing, debt pressure sees some release, right? So as we're looking at this stuff, mortgage and fixed index rates, as I mentioned, used to be as high as 8% in 2023. So this is moving this down. But credit cards and variable loan rates, right? Credit card APRs climbed to a record 21, almost 22% in 2024, but cuts pass through quickly, giving households modest but immediate relief. So this is why, if again, we're not fans of debt. We're not fans, and if you're having to meet lifestyle on a credit card, it's very dangerous. But sometimes life happens. Maybe you lost your job unexpectedly. Maybe a family illness or something. So we'll never judge you, but we should go into it with our eyes open as to what does this mean overall, and that's one of the reasons why we offer, our analysis. You are here, our retirement analyzer. Are you at risk of running out of money? And we can apply very conservative estimates to stress test overall how we think your overall financial health looks. And then, the big picture again, the market performance, equities tend to welcome cuts. So, big picture, cuts tend to be positive for equities. In 1995, there was a soft landing after rapid hikes, grow steady, inflation spelled. So, in 1995, right here, right, we had this little bit of a boost here, right? So, we're like, okay, this helped. 1995, the S&P 500, they cut the rates, but right here, you can see this upward trend. 2008 hard landing. That's this chart right here. That's this gray bar. And we all remember, and if 2008, having lived through it, was very, very dark times for a lot of people, right? We've seen, net worths and 401k statements and brokerage statements lose 20, 30, 40, 50% at a time in most people's lives that they could not afford to do it. And this is where, this hadn't happened before. So we have to just be cognizant. What's our plan if this happens again or something like it? And there are mechanisms. This is the crazy thing to me is I've been in this business for over 30 years now, that there are tools, that there are strategies that we can put in place to reduce this so that, hey, listen, I don't need to hit a home run every time I'm at the plate, but I sure as hell don't want to strike out every time. And I definitely don't want to not be admitted to the ballpark, right, and lose money and go backwards. And, I lost my ticket and I lost my money and I crashed my car on the way to the game and all the things that could have possibly gone wrong. Versus, you know what? I'll take a zero for a year or 2 years, even 3 years, if versus losing 30%, because eventually things will come back. So again, my professional opinion. And again, I keep hitting buttons and fat fingers. So, savings and cash yield, the big picture, savings accounts, money markets, and CDs surged during the hiking cycle, giving some of the best cash returns. This is where, a lot of people, but as change is never easy, and as we start to see things will start to settle back, you're going to start to see, you're going to be looking for options. So, again, the rates are going to change quickly. If you have any desire to maximize yield, no obligation, reach out to me and we're happy to see what we can do for you. All right, I just finished up. I was speaking up in Hackensack, so I drove all the way up. I was asked to speak up there to a bunch of advisors at Maggiano's for a lunch and learn, so we did that. But I just finished up, as I mentioned, Rutgers, Social Security, maximize Social Security, uh, great events. We do those, typically 2 or 3 times a year. But Maggiano's will be on principles of retirement. Nothing will be sold. We like this venue. It's in proximity is where my office used to be. It's in the Bridgewater Commons. But there are a few seats left. We've done a mailing, hard mailing. It's going to all the households. People are registering every day. But because the folks that are on here, sometimes you're maybe not in my mailing list, whatever. If you want to attend, please reach out to me. We will send you the link. And you can go to our website, Professional Planning Services, and under the events, you can use your link, or Caitlin should have just put it in chat. But one of the two, we would encourage you, if you would like to attend, no obligation, please feel free. On my dime, on Professional Planning Services dime, it's purely education on the principles of all the things we should be thinking about for retirement. However, maybe you go, I'm good. But don't keep us a secret. If you think that anything that we've been doing over the years has been beneficial for the community and more people need to be made aware of, please share what we're doing and just give them a shot to say, hey, go check out for themselves. Let them do the smell test. Let them see, hey, do you like us? Do you like what we're saying? Right? There's no smoke and mirrors, and you got to deal with somebody. So you might as well deal with seasoned vets that have your best interest in mind. So. And then lastly, we're at that time of year. There's Janet and Madalena's, and we give away for Thanksgiving. It's our way of giving back to the community. In 2 weeks, Thanksgiving will be here. And, from our family, from Professional Planning Services to yours, we offer anybody that would like a Madalena's apple pie. They're incredible. We love them. I look forward to them. People, they're up in Flemington. You can drive there. We already reserved them. We tell them how many people are coming up. You just need to say, yes, I want a pie, and I'm willing to go get it. Right. So if that's you, please reach out to us as well. We're happy to help. And then lastly, here's our disclaimer. Right. So these are our just saying that everything I told you has been, gone through compliance.